Planning Group CEO and investment advisor representative joins us now in studio. David, great to have you in from Kirkland, Washington.
Yes, sir.
David, you've got 5 issues with bonds right now. So let's break these down, starting with seesawing. What is this, and just define how this is one of the issues?
You know, what happened in 2022 when we were seeing the bond rates rise again is that we saw that the net present value, or the value, if you had something that was paying 2 and now you can get ones that are worth 4, it's worth less in that new environment. And so we're losing money. So as the 10 years going up right now, this is adversely affecting retirees that are holding on to these dollars as though they are literally the safety net that they're depending on.
You also warn about net present value versus inflation. Why is that?
Okay, so when we talk about net present value versus inflation, I personally run my own inflation. So I'm at 6.2% this year, which is a little bit down from last year. But if I can make 4% and I'm going backwards 6.2, I've lost 2.2. Therefore, I'm losing money because I'm getting a guaranteed lower rate of return.
Interesting. So what are the risks of a credit downgrade as well? This is also one of the considerations.
Yeah, absolutely. So if we go back to 2011, we understand that we got our very first downgrade as a nation from AAA to AA. Fitch just came back last July and did a AAA to AA, and now Moody's is the last one. And I think there's a probability that Moody's gets moody on us if we continue to spend like we have been, et cetera. And so I'm really hoping that we don't get to that point. But if we saw downgrades, you go to BBB to BB, yeah. That is very expensive.
Interesting. When we think about the risks to bonds right now, there's also a supply and demand balancing that needs to be considered as well. Why is that one of the larger weights into the bond market mindset?
Well, because it's called systematic risk. And so when the sellers want to sell more than the buyers want to buy, it doesn't matter if it's stocks and bonds, they just want to go to cash. What happens is the market's looking for a bid. And so if you want to get out, but someone says, I'm not going to take the same price and risk as you may have had when things were cooler and calmer. And so they'll give you a lower price.
And then just lastly here, you have one of the risks, the potential risks in the bond market, default.
That's right.
What would that entail? How would we see kind of the warning signs of that and the flashing signs of default prior to it really impacting the bond market?
This is the hardest part, because if we look at 2008, Bear Stearns, Lehman, these are the definition of A-rated safe places to be. And yet they fell apart, and the investors received nothing in return. Washington Mutual is a big one here in hometown for me in Washington State. And there's a lot of people that had biases that fell apart because their bonds no longer were any good when the company was in there.
All right, really fascinating. We're going to continue to watch those signals as well. While we have you, you warn a market downturn and high inflation are the greatest risks for retirees. Why is that?
Okay, so a market downturn within the first 5 to 10 years of retirement, it's called sequence of return risk. And so if we have a big downturn, we go from 500,000 to 300,000 in our accounts, we have a lot less money to spend at a time when we really need it. And so it's that 5 to 10 years in retirement, in that very first part, that is the biggest factor mathematically to being able to distribute without running out of money.
We've been running higher in the market.
Yeah.
And I mean, this bull market run that we've been tracking, of course, even as we've had some of the strategists start to talk about if we could be at the beginning of a correction, we haven't seen that correction yet, and we haven't seen it reverse to the point where we're in a bear market.
That's right.
So how can they use reverse mortgages even to tap into home equity, even if we did see that bear market come to fruition?
Okay, I like what you just did right there. You said reverse mortgages. Now, some people think that's a swear word. I don't believe that's a swear word. They're called HECM mortgages, okay? And so here's an average example. Someone's got $500,000 in the portfolio, $500,000 in equity. They're going into the fight of their life in retirement with one arm tied behind their back. This gives them the ability to utilize their equity that's also tax-free as a distribution. And so that's a really powerful idea when you're blending assets in a probable time frame when you've got higher taxes. We've also got the Tax Cuts and Jobs Act 2.0 that's upon us right now with President Trump coming in. And so this is literally the single greatest opportunity in any of our adult lifetimes to reduce or eliminate taxes on our retirement dollars. And so in conjunction of distributing more tax preferential money, like from a reverse mortgage, that can actually help to reduce the bottom line that you pay under 1040.
All right. David, very fascinating. Next time, let's do this from Chambers Bay, why don't we, out in Washington?
Absolutely.
Much more scenic.
I'm into, Brian.
But we love the city over here. Thanks so much for joining us.
Pleasure.